then at the right moment, when this chart starts to move, I slowly DCA from Bitcoin into sand. You see? Then when Bitcoin and sand peak on this chart, on the weekly, right? And this weekly gets up here. So this is what you would have done. Back in here, you would have been DCAing. Check 1, 2. Is this thing on? Oh, I was just messing with my Treasure Hardware wallet. Get yourself a Treasure Hardware wallet today. Link in the description below. I'm telling you right now, if you don't have yourself a hardware wallet, you're going to be missing out on possibly your own crypto. So get yourself, you'll be missing out on a hardware wallet and possibly your Bitcoin. So get yourself a hardware wallet today. Stash those Bitcoins in a safe place. Don't let the exchange or some, hot wallet on your computer hold you down. Shout out to everybody here on the live. Thank you for jumping on in. We're going to break it down for you. It is Fed meeting. The Fed's going to have a meeting. Yes, that's what's going to happen. The Fed talks. They have a meeting. And what they do is they kind of discuss and give us a little bit of foreshadowing as to what's going to happen at the next Fed meeting. This is the beginning of what the Fed meeting will begin to bring us. And this is kind of why we bring this. In 3 minutes, the countdown to the Fed meeting will come in here at 2:30 Eastern Standard Time. I didn't want you guys waiting too long. I always used to start at 2, and then I sit there and I don't know what to do for 10 minutes. And I'm like, we look at the charts, we have fun, but it's time to get the brass tacks. Something I'm looking at, no Fed meeting at all. The 1 hour was bullish today. It was oversold with a beautiful curve. The momentum came all the way up. And again, as a momentum indicator, the momentum came all the way up. And so far, let's double click on the Stoke. I mean, the Stoke's pointing up, but it's kind of curving there, giving signs of a possible, reversion back. We're going to make a move back down as well. This falling wedge so far, I'm going to take away. I have too many lines, number one, and that little right there, but we'll get around all this. So the falling wedge did break to the upside, but it could not get above the POC at 21,191, 21,200, right? 27.2. You got to get above 27.2, right? That's going to be, now this still is a cup and handle, and it still looks okay. And this, at any moment, this could flip back to the upside. Our 15-minute, however, had all day to dump on us, even with the bearish div, and didn't dump too bad. That's interesting to me, right? So then I go to the 4-hour because I'm like, all right, and the 4-hour looks bullish with a bunch of wicks. 1, 2, 3, 4 wicks. The last time I saw that many wicks, we got a pump. 2 wicks here, we got a pump. 2 wicks. You don't even see 4 wicks on the 4-hour usually. 2 wicks there. There's a bunch of this. 1, 2, 3, 4, 5. Technically, we eventually was showing us buy pressure. So that's a lot of buy pressure for Bitcoin in the 4-hour time frame. 4-hour looks absolutely bullish. This thing could take off. Like you read about, this is a bit of a cup and handle. At the same time, I'm watching this, what's called an ascending triangle, right? We're sitting here watching an ascending triangle. And if we lose this level, we're going to break down. Our measured move takes us to about 26,166, 26,200. If we break up, the measured move takes us to about 28,200. I am long right now based on the 4-hour time frame, but I was long based on the 1 hour being oversold. We got our move back up and did not get above resistance. So there's a chance that I have to close the long because the 1 hour could go against me, take the trade down. What that will do, though, is we kind of have a, we could go here too. One here, and we may double bottom, and that could be the reversal back to the upside as well. So I'm watching both ideas. I'm not bullish or bearish. I'm open-minded, and I'm going to take whatever the trade can give me. Right now, I'm going to trade the 4-hour to the upside, but I'm heeding the fact that the 1 hour could end my trade and push me to the downside. I am long right now. This is the exact trade that I'm in. It's posted right here in front of you. My entry anywhere in really between 26.2 and 26.150, and take profit would be 28,600, and the stop loss is below this lower, that trend line and that lower low there where we had a resistance and a support move there at 26,723. And again, that gives me a 2.94 risk reward ratio. With that being said, everybody, we are going to jump into BTC, USDT on MEXC. I'm going to jump on into probably the 1 minute chart. All right, I'm going to delete all my work. First on the one, let's go to like a bigger time frame, and I'll make some key support and resistance levels because we're going to be dealing with a small area. And let's jump on into here what Jerome Powell has to say. He's about to begin speaking. All right, as before, this will be on the right. Bookmap will be on the left. It takes me a second to coordinate this, and then we are going to be ready to rock. I'm excited. You should be excited. Fed meeting. Let's see if they've started yet or if they're late. Here we go.
At a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Have we?
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
listen to that. They're
Looking
dumping on
ahead,
us, though.
we're in a position to
see
proceed
that?
carefully
Dumping.
in determining the extent of additional policy firming that may be appropriate.
And continue to reduce our securities holding. Dumping
Our
on the market.
decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks.
7 minute looks
I will
bullish
have more to
for a
say
move
about
out of the
monetary
flag.
policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year,
But you don't
growth
like
in
that.
real GDP has come in above expectations.
Possibly to 27,400.
Recent readings on consumer spending have
Seven
been
about to
particularly
explode.
robust. Activity in the housing sector has picked up somewhat, though it remains well
kinda
below
wanna trade
levels
that on
of a
another
year ago,
account.
largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains
Participants.
tight, but
Who the
supply and
heck are
demand
they?
conditions continue to come into better
know?
balance.
Ridiculous.
Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC
Oh, there's a
participants
beautiful
expect
pump
the
on the seven.
rebalancing in
See?
the labor market to continue,
Seven's pumping, man. I knew it.
easing upward pressures
I
on
knew it.
inflation.
It looked really good to me.
The median
Sitting here
unemployment
fumbling
rate
around. I
projection
wanted to
in
open
the
this trade on
S&P
another
rises
account.
from 3.8%
Look at that
at the
pump.
end of this
And
year
that's just getting
to
started on the Stokes.
4.1% over the next 2 years.
That's going to boom.
Inflation remains well above our longer run goal of 2%.
Bookmap wants 28,000.
4% over the 12 months ending in
Ooh,
August.
we're cooking right now. Our trade's in the
And that
money right
excluding
now.
the
We're in the
volatile
money right
food
now,
and
everybody.
energy categories, core PCE prices rose 3.9%.
Not this trade, the original trade, but we're still in the money.
Inflation has moderated
Colby.
somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early
Never
last
gonna
year,
get there.
we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings.
Dumping on the market.
We are committed to achieving and sustaining a stance of monetary policy.
Why were you
that
holding
is
securities
sufficiently
in the first
restrictive
place?
to bring inflation down to our 2% goal?
Why were
over
you
time?
buying stocks? Like, so weird.
In our SEP, FOMC participants
Like,
wrote
what
down
the
their
heck?
individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic
Seems really weird and
the
reserved
median
today, right?
projection is unrevised for the end of
Something
this
weird
year,
about 'em
but
today,
has moved
yeah.
up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve
So
as
far, this is a
projected,
nice
the path of
breakout on the
policy will
7.
adjust
Looks like
as
it's going to
appropriate
continue on the
to
Stokes.
foster our maximum employment
Try to
and
break
price
this high.
stability goals.
Got to break above this high, or it's an M pattern.
We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook.
There's a
and
nice
risks.
pump there. Here we go. Break
Real
this high.
interest rates now are
Close to
well above
7 above the
mainstream
high.
estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate,
He looks MK
and we
Ultra.
intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal. and
That's
to
it. That's usually where he ends. You know? Why? Right when I said that. Isn't that weird?
keeping longer-term inflation expectations well anchored.
Strange.
It's essential to set the stage for achieving maximum employment and stable prices over the longer
Go
run.
AMD.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh, here we go. So he didn't say anything.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive,
Colby.
especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed
Dumping
to
on the
achieving and
market.
sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that.
He's like, I just want to make sure I said the things on the
But
paper here.
the fact that we
What else
decided
did
to
I miss?
maintain the policy rate at this meeting
Insanity.
doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP,
Flushing the shorts now.
obviously will have done,
I mean, the
you'll see
long's
that
down.
majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings.
That's
this year.
bearish, see?
Others believe that we have already reached that. So it's something where we're not making a decision by
If they say
deciding
they
to,
never raise rates again, oh my
about that
gosh.
question by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today
Bounce,
that we've
baby,
reached
bounce.
this level.
Oh, it's so bad.
We're not saying, yeah, no, clearly we are just, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate
Bearish
level.
div,
And-
swing
and,
down
you
and
know,
swing down, swing up
we've
to
seen
swing up.
progress,
It's not funny,
we
right?
welcome that. But, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right, so I would say it this way. First of all.
Which way? Which way would you
interest
say
rates-
it?
Real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need our policy to be restrictive.
Sorry, it might hurt
so
your
that we
ears.
can get inflation down to target.
Might have pissed
okay?
you off, sorry.
And we're going to need that to remain to be the case for some time. So I think remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects.
How funny is this? We ask him about the plan, and he tells us, well, these are just a group of people that make the plan.
Stronger than I think
everyone's saying different
expected.
things, so don't take it as a plan.
So what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is
But it's just a plan
progress toward
that we
our,
don't know is a plan
toward our
yet.
inflation goal, as you see in the SEP.
But it's just a plan that we're not sure is a plan yet, though. Don't ask us about the plan because not everyone's agreed on the plan yet, so it's not the plan.
Hi,
But this is
Chair
what we
Powell,
think is going to
Rachel
happen,
Siegel
so
from
that is the plan?
Washington Post.
No,
Thanks
no,
for
no,
taking
no,
my
that's not the plan.
questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing?
He's not gonna answer this
Could you
either.
Walk us through what this disagreement was about at the meeting.
Wow.
Yeah, so the proposal at the
What a
meeting was to maintain our current
Which plan?
policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that, people just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see.
Oh my God,
you
Bitcoin's
know,
at
the
27,150
labor market
again.
report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. They want to be careful to not
can't be convinced on
jump to
latent
a
indicators,
conclusion
man.
really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would
They don't know.
no
If
hike
they knew,
do?
they wouldn't have done it,
Game
right?
that out for us.
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be.
Are we talking about like
But we're always gonna
HPV
be
here, or are we
learning
talking
from
about
data.
the economy?
We've learned all through the course of the last year that actually we needed to go further than we had thought. We go back a year and what we thought.
A
what we were
cluster?
working on, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get.
Are we talking about
to a
hiking up the
place
mountain,
where
or are we
we're
talking about
confident
rate hikes over here?
that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been
Never gonna
moving
get it,
toward
never
as
gonna
we've
get
gotten
it.
closer to it.
Never gonna
We've
get
slowed
it,
the
never
pace at
gonna
which
get
we've
it.
moved. I think that was appropriate.
Not this time.
And now that we're
No,
getting
no,
closer,
no.
we have the ability to proceed carefully.
Proceed carefully.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's
Oh, he
question
slams
here.
them usually. This guy.
What is it saying about the committee's view of the inflation dynamic in
Lies,
the
man.
economy?
His last name says lies, man.
Achieve
Like
the
his
same
Leishman,
forecast
but it's.
inflation rate for
I would
next
change my
year,
name if it said lies,
but
man. in
need
it.
another
I
half
love this
a
guy. I'm
point
just
of
saying.
the funds rate on it. Does it tell you that? Does it tell us that the committee believes inflation to be more persistent, requires more medicine, effectively? And I guess a related question is, if you're going to project a funds
like this
rate
dude, though.
above the
He goes
longer
hard.
run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the
Why don't you
recent
pick up
data.
your glasses?
It's more
Doesn't that
about
hurt your nose?
stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't, you know, the model.
They don't. Oh man.
And that the economy reacts, and again, that's another reason why we're
Build,
moving carefully now,
build,
because
hold.
you know there are lags here.
Let's get the
So
lags.
It may.
we
of
talking
course
about
be
the
that-
internet
that
over
the,
here, or-
that the neutral rate has risen? You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than.
He just shape
than
shifted.
the longer run rate. Remember, what we write down in the SEP is the longer run rate.
That's funny.
It is certainly possible.
Got some
that,
reptilians in here.
You know, that the
A new
that
guy?
the neutral rate at this moment is higher than that, and that that's part of the explanation for why the economy has been more resilient than expected.
Let's get some head and shoulder vibes, right? That looks like it might be dumping.
Howard Schneider with Reuters, thank you. So you've said several times that the economy needed a period of below-trend growth
This dude's
to
cool.
get inflation
I like this guy.
consistently back to 2%.
Looks like an old beat poet
Kind of
from
get
the
that in
70s.
2024, a little bit, 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of
What a good
supply
point.
healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right, in the median forecast, we don't see a big increase in unemployment. We do see an increase. And, but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, you know, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and you know, I also think you know, this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think you know, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timros of the Wall Street Journal.
Nick, I love this guy.
Chair Powell, both
Chair
you
Powell.
and Vice Chair Williams
Chair Powell,
have
ma'am.
indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope
Nice
for
tie,
nominal
Nick.
rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
Nick, we have no idea what you said.
Yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again,
Nominal
I would
rate versus
say
real rate.
You know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, you know. And so what are we seeing? We're seeing, you know, through a combination of the, you know, the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, you know, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working.
We'll get into this for
And,
you, so you know exactly what he's saying.
I think what
About the
you know, as
difference
we've
between the
said,
nominal-
we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, you know, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level?
He just let it
and
slip.
that's a whole other set of questions.
just let it
For
slip.
now, the question is,
Rate hikes are
trying
over,
to
guys.
find that level.
Pump
where we
Bitcoin!
think we
You
can
heard that?
stay
He
there.
just let
And
it
we haven't-
slip.
We haven't got.
They're not going to raise rates again
a
this year, man. I could be wrong, but I'm getting this vibe. I'm getting this vibe.
point of confidence about that yet. That's
Now you got
that's what
falling
we're-
wedge.
that's the
Could you
stage
break
we're
out?
Year. And even then, it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
Double bottom.
The
See that?
decision that we make at each
Clean
meeting,
double
and
bottom.
certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year as
27.8,
inflation, kind of, again, to Nick's point, as we
26.6.
see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the
Thank you.
logic that you
Appreciate
apply. You know, is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, you know, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, you know, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're as we go into next year, that's the question.
Double
we'll be
bottom is
asking
pumping there.
Is, you know,
Like
taking
it
into
should.
account lags and
It's a double
everything
bottom.
else we know about the economy.
Thank you.
And everything
Appreciate
we know about
that.
monetary policy. The time will come at some point.
Please subscribe,
I'm
hit the
not saying
like
when,
button and notification bell.
that
Find out when
it's
we're live
appropriate to
every
cut.
single day, 10 a.m. to 12
Part of
p.m.
that may be that real rates are rising because inflation.
Saturday and Sunday night.
Part of
8
it just may be that it'll be all the factors that we see in the economy. And, you know, that time will certainly come at some point. And what you see is us writing down, you know, a year ahead estimates of what that might be. And there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Estimates made a year if they're highly uncertain, then why
Thanks
make
so much,
them at all?
Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is.
Thank you. Appreciate that.
That's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria. Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
Wow.
So there is a long list, and you hit some of them. But it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs.
You don't stand for the working people?
The thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain and
What? We'll get it. We'll get it.
We'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy.
Oh my God! Bitcoin's at 27,150.
Thing.
Again.
Energy prices being up can affect spending.
Amazing.
What
do you know?
A sustained period of higher energy prices can affect.
Really likes
consumer
27,150.
expectations about
Loves
inflation.
that number.
We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add
What
skills.
he's doing with his hand?
Workers want to work.
What are you doing?
We have a boom in manufacturing.
Why is he moving his hand like that? That's so weird.
We've had a decent spate of home building.
What is he doing?
And since inflation's
doing
coming
that?
down with strong GDP growth,
What if I was on the live doing this the whole time?
All are which good for
What is
the
going on?
Fed's
What the
longer run target of low inflation.
You stopped.
And if we lose that in a recession,
You must be reading notes.
aren't we opting for the awful hysteresis that we had in 2010? So
I
are you
wrote this
taking
last
into
night and read it
account
like
as you
100
pursue
times in front of the
policy?
mirror. I was
Thank
like, I
you.
can't wait to be on camera.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time.
Oh.
The
Oh.
real point, though,
Oh,
is
so what do we, like, then what are we talking?
the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect
Every
growth,
situation
it'll
is
affect all
unique,
kinds
though.
of
It's
things.
like
It
a
can be
trade.
a miserable
He's like
period
taking
to
a
have
trade.
inflation
Whenever
constantly coming back, and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone,
Little
we
flag could
believe,
break
is
out.
to restore price stability.
27,200.
I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do.
What does that
So
mean?
we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important large
27,267 on
increase
the
in
board for
unemployment,
a
which has
move
been
here.
typical of other tightening cycles.
Starting to get a break,
So-
possibly.
Hi, thank you. Chris Rugaber at Associated Press.
Chrissy,
When you look at the
Chris.
disinflation that has taken place so
This
far,
guy with the mask on.
do you see it mostly as a result of
My God.
what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take,
Do I know what you're...
as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be...
Get the likes up to the watchers. I
In
greatly
addition,
appreciate it.
monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television.
No, he
and Radio.
didn't say anything.
In June, you forecast a 5.
It'll come back. Just give it a second. We're running a lot of steam here. And it goes. I think it's the Fed's feed, really, but we'll find out. Could be Discord. I'll close Discord. It takes a lot. Probably people.
What would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come.
She's like, I'm getting a
way
low
down,
shot.
Largely due to
Don't play
lower
me.
energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult.
Kind of a
and is
shoulder
highly
head and a
uncertain
right shoulder. It's a
forecast,
mess,
but,
though.
These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast, that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made.
But nothing's
And
happened.
I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate
We
to
think.
bring inflation down to 2% over time,
Over time.
you know, the risks become
Over
more
time means
two-sided.
2,000 years. You
And
know that,
the
right?
risk of over-tightening and the risk of
Over time could be infinity.
under-tightening
Over time.
becomes more equal. And I think
It literally could
that
take
the
forever.
natural common sense thing to do is as you approach that, you move a little more slowly.
I'll build
as you
that
get
wall over
closer to
time.
it, and that's what we're doing. So we're
Smart,
taking
man.
advantage of the fact that we have moved
We
quickly
both did it at the same time.
to
Weird, huh?
move a little more carefully now
That
as
was
we
weird.
as we sort of find our way to the right level of restriction that we need to get inflation.
I didn't know
back
he was
down
going to touch his
2%.
head like that. That was so strange. He did it again when I did it. Oh my God.
Thank you, Chair Powell. Jennifer Schonberger
He had,
with
a itch,
Yahoo
he had the ear
Finance.
itch.
With your focus on year-over-year PCE, isn't it
People
true
touch their
that
head, there's something
base
that- it
effects
means
are
something.
huge, and that by the time you meet in November,
sending a
that it's
signal.
more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors. Okay. So
That's so funny.
on that, we're looking at just right? You can look at just monthly
She's a
readings
sweetie
and
pie.
see what the
No.
increase was from the prior month.
585
So you're
people,
right,
259
you go back
likes. Let's get the
3,
likes
6,
into the
and 12
watchers.
months
Thank
at the
you.
Base factors, but we can adjust.
My name's
to
Samuel
that.
James Price,
In
traded for
terms of
15
not
years.
getting
Jump on
data,
it.
again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And,
I think I just breathed in a
I don't know.
ball, man.
It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects?
Give her the mic back.
As those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
She got a
Yes,
big
I mean,
hive right there, right before the thing.
If you're looking, we can tell how much inflation has gone up in a given month, right? And, that's what we're looking at. And month by month, what's the reading? And, I think what we're really looking at is there's a tendency to look at, shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really
That's a cup
6
and
months
handle
inflation.
possibly,
So
too.
you're looking at it over
Take a
that
break to the
period
upside.
and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve. So.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Ron Paul, man.
Hi, Jean Young with M&I Market News.
How's it
Yields
doing?
along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
I mean, he's going to say the
So
same thing.
you're right. Rates have moved up significantly. I think it's always hard to say precisely, but it's most people do.
If you have a hard time hearing, it's up to you, man. We got the volume
the view will be
extremely loud.
It's not mostly about
Just turn your
inflation
volume up, my man.
expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
It's a long one. He was short last week, man. Last time, remember? Bing, bing.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this.
If you can't hear Jerome Powell, it's on you, man. It's mad loud.
Mortgages being higher now than they
Come
were
on now.
at their
We've been
recent
doing this for
historic
like
lows.
months at the exact
How
same
is that
level.
going to impact future
Let's
thinking
get real,
about
guys. I love
taking
you all.
interest rates to that lower bound in the future?
So on
Take
the
a poll.
supply point,
Is Jerome
of course,
low?
supply is very important.
Sounds so
over
loud in
time
my ears.
in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off.
Here's the
and-
poll. I'll
and
listen to you
being
guys. Is
re-signed
Jerome's
or
audio low?
released
Yes or
at
no?
a
Let me
level
know.
That's
Let me know.
it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down.
Now I lost them all the way, right? Because you guys are mad.
Is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and
Sounds so loud to me, it's ridiculous.
Move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates. No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Thank you for
Hi,
the
Nancy
subscription.
Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending.
All the time.
It's a good thing that the economy is strong.
All the
it's
time,
a good thing
United
that
States.
the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you
She's like-
worry that that could contribute to an economic slowdown or even a recession?
Are
Well,
we in a
that's always a
recession?
concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how
Thank
quickly
you.
we've come here,
Appreciate that.
we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced
Lowest we've been all day, right?
before last year.
27.40 now.
What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So what?
More about the drop here.
I guess it's fair to
The
say
1 hour's
that
bearish.
the economy's been stronger.
I just want to make that clear.
Than many expected.
All day we waited for it to pop, and
what's
it
been
did, and then
happening
it's
with
rolling
interest
over
rates.
right
Why
now,
is that?
so-
Many candidate explanations, possibly.
There's even kind of
number
a
them make
descending
sense.
triangle here,
One
look.
is just that household balance sheets and business balance sheets have been stronger than
That's
we
gonna
had
dump.
understood.
Those dump fast, right?
And so that's spending has held up and that kind of thing. We're
Descending.
not sure about that. The savings rate for consumers has come down a lot.
Straight line
The
to
question
the
is whether that's
downside.
sustainable. That could be. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate
Ruined the trend line.
of interest is
That ruins
higher
my trade.
for various reasons. We don't know that.
Could
It
be a
also
stop hunt,
just
but-
be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth.
Wow.
By many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes.
Nice liquidations coming
On
now.
your second question your second question was distributional, but can you be a
26,000.
little clearer about that?
The 1 hour
yeah,
wants to dump.
my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we
Measured move for
we
this
wanna do it as
descending
quickly
triangle is pretty
as
far down.
possible. Obviously,
you could be
we-
nice
we
and
would
say-
like to do that. We'd like the current trend to
All right, there it
continue, which
goes.
is
Somewhere
that
to, like,
we're
26.3,
making progress
6.7.
without seeing the kind of increase
the
in
double
unemployment
like
that
a
we've seen
bottom
in
here.
past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that
Lost the
more. They
POC,
are.
you're going to drop down.
And of course, people with lots of savings also have a much lower marginal propensity to consume, and so they're not going to. It's not going to affect them.
Bulls need this to wick back up in the pattern to remain bullish.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with a sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of
Interesting.
that
That's a good
sector. Thank you.
question.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering.
I would
from-
stay short
from
till we
high
get to the
inflation.
target, but you do whatever
I
you
think
want.
during the pandemic,
Coming to 26K,
the
it looks
government
like.
transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind
With
of
the bearish retest, unless
a
we
guess
V-shape
at what
right
the
back
answer
in
might
there,
be. But I think there's
which we
there's
very
a lot
well
of
could.
good,
There's some
good things
bullish
happening
div on the
household
indicator.
balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
And that's it, everybody. He's out like a light bulb. All right. I like how he ends it quick. All right, so the rate hike stayed the same. We knew that from the CME Watch tool. We knew that from months ago, like weeks ago, really. Now we wait for the next meeting, right? And this will change. This might have already changed, actually. It should have changed to the next meeting by now. Wow. Now we have a 99% chance. Wait, did they shift this? Yes, no, September. Okay, they haven't yet. Yeah. So November 1st of 2023, what are we seeing here now? And it's nice. We get a little break here. We don't get a meeting in October. Our next meeting is November 1st, All Saints Day, the day after Halloween, which is interesting, right? But right now, we're sitting at a 75% chance that we do not get a rate hike, a 24% chance that we do get a rate hike. So, right, and we look at this probably almost every day on my channel, and we update you on it, and that's something that we'll be looking at. Again, let's take a look at bookmap for Bitcoin for you while we're sitting here. I'm going to just kind of break it down for you, for each and every one of you. We're going to look at, let's just say any chart, really. The KuCoin chart works for me, the MEXC chart, whatever makes you happy. This one works. Let's see what's going on for Bitcoin. Bearish or bullish? The daily, 2 wicks. If the daily closes today, that'll be tweezer tops on the daily. That's a bearish sign. The daily's in a rising wedge. Rising wedges break down 68% of the time. All right. You also could not get above this resistance. So the daily hits a resistance, can't get above, makes a rising wedge, and could break to the downside. So the daily right now looking bearish, period, right? And overbought on the stochastics, momentum on the MACD, everything kind of says, and these usually break down to where they began. So it means we'd be retesting somewhere at 26,000 to 25,800, all right? So that's a possibility right now on the daily. The daily doesn't look amazing. So the 22 also looks bearish, like it's beginning across, and it got a resistance right there too. And that would break back down to where this would begin at least at 26,000 for 547 or 26,000, no, 25,725, sorry, 25,700. Sat on my hands and almost drove the tracker into the pond. That's funny. Who remembers Big Boy been yelling at Bumptober that one time I was there? Those were good times. Bumptober. Capitulation happened in the 15-minute chart from here up. So now let's take a look at our 4-hour time frame, right? 4 hours still looks bullish to me, and can we hang out inside the pattern? Let's take a look at what we were originally looking at. So the daily, we kind of just set that for you. Rising wedge, remember that, smaller time frames can negate that if we can break some key levels. So let's take a look. Right now, the daily does not look good. The only thing that could save us is a smaller time frame getting a pump. We've seen it happen before. I've seen the 7-minute. I've seen the 4 hour say it's going to dump, and the 7-minute pull off a miracle. So anything is possible. All right, we have to look closely. So retest, we came up. Previous resistance became support. We formed this bull pennant. I call that beautiful call to the upside. We got the move, right? And now here we are again. You could almost say we're still inside the pattern. I consider this just a breakout, right? And a break back inside. I don't really consider that part of the bigger pattern. It's a chance that we do get a bounce back to the upside here. Let's take a look at the 1 hour. 1 hour says no. The 1 hour says we are about to dump hard. And that brings me back to this descending triangle that's just getting started. And I even take the length of the pole there. So I would just remain short, really, for Bitcoin based on this descending triangle and the stochastics. They just don't look good to me. 26,900, we broke some key areas, right? 27.1 really needed a hold. And so we'll see. We are bouncing up and down right now. The small time frames, look for bear flags, bull flags. Right now that almost looks like a little bit of a bear flag here, see? And that could continue to the downside. I still no reason to remain long now until you can get back above 27,100. That's a major resistance point. I just really see no reason to remain long. 1 minute looks like it's about to dump. To the downside, target would take us to 26,559. And you're looking for that bullish div. It's really not that strong there. We need to have it down here, and maybe it can get the bounce. Again, I'm not perfect. I'm not 100%. But right now, that 1 hour time frame out of a descending triangle looks to break down. And interesting, all patterns, right? They're not on here. Hold on. You go here and you go to technicals, patterns, and click all patterns. And add that to my chart, right? And then look, it has a descending triangle right there drawn. And it has the target pretty close to my target right there. These two targets. Has a double top, So, and we could take away this one and just say inputs. And just say only awaiting or awaiting and reached. No, we just want last awaiting or only awaiting. I want to kind of get these off because they're hard to see and just show you the descending triangle. But they got a descending triangle here with a move to the downside. It's interesting. Again, you don't have to. I usually don't like to trade right after the Fed. I let the Fed kind of do its thing. I wait. I usually go for a walk right now. I actually have a big lawn I got to mow. I owe a property somewhere, and we just got the keys. We closed on it, and the grass is super long. The people that sold us the property didn't even cut the grass when they sold it to us. Hey, if you're selling a property to someone, man, sell it to nice and prim and proper. But I get it. Do the least they did the least they had to do, right? Why even pay for that? So I'm actually going to go cut that grass, right? And I'm just going to leave a short runner on here to see if I can catch a short to the downside to this target. I would look for liquidity to get 26,450. That's where a good place to take some profit would be. So again, I see a movement to the downside. I'd watch the smaller time frames. This bear flag looks like it could definitely break you down, and I would stay short until we get back above 27,100. Now, we lost some key levels. We did. Glad to see you, my man. Got you on X now. Just had to pin up another job. So usually at work around these times. Cool, man. Yeah. Long purge before the PAMP. I'm going back to the chores for the rest of the day. I think that's the safest thing for me to do. Amen. Looks like a nice shorts on our hands, though, on the 1 hour time frame. 1 hour rolled over. The stochastics got to the point and didn't give us what we needed, so it was likely we were going to get a dump to the downside. So that's just how it is. I see this descending triangle breaking down to the 200 SMA, 26,570, even somewhere down to this liquidity zone at 26,450. So I would remain short if I was, going to trade anything. And, and I'll pick this back up in about 2.5, 3 hours, about 5, 6 o'clock. And then I do my morning, my daily candle close video for my trading group, depending between 8 and 10, depending on what's happened in the market. And I'll also scan to see if there's everything going on. I see some people kind of fiending for Casper right now. I would be careful. All right. This is October and the Dow Jones. Boom, boom, boom. Every October we have a big move. October's coming. Do we come down and then get a move? It's interesting. So I just wanted to point this out. There's only a few Octobers where price started to dump. This October of 2010, boom. 2011, boom. 12, boom. 13, boom. 14, boom. 15, boom. 16, huge boom. 17, boom, came down, boom, but still boom at the end of the day, right? This one started to go down, but ended the year huge. This one started to come up. Even the pandemic, you still look. If you bought in October, at the end of next year, you still were up because technically you bought in at this level, and the Dow was actually higher by the next year. And then here, boom. So if you buy and hold from October to October, it is look like it's paid off every single time. If you buy here, right, in January and you hold down till January, you could be down in the dumps, you see? So when the month you buy and the month you sell is different from here to here. So someone could go from here to here, someone go from there to there. The market's not that much different, but this guy made a lot, that guy lost the money. So interesting, right? How the markets play out like that in your favor or not in your favor. So just remember, October is coming upon us. Stay tuned for that. That's interesting. And I did some work on that for you guys. I did for myself. I'm super interested in that, but I thought it would be really fun for us all to look at that together. And I'm a nerd like that. I'll be like, oh, my group will love this, And I spend my whole time just thinking of cool ways to help, All right, so Casper to me will probably dump with Bitcoin, right? And moving average is a little far apart. If it can hold this level, it's attempting to really hold this level, see? It's really saying, hey, can I hold this level? And the 1 hour's oversold already. I'm going to delete everything. I got an EMA. I don't need that. Moving averages. Because I'm watching this too. Like, I'm like, do I want to long this? Is it right? Is it wrong? It's tough. Casper's tough. Right now, the 12 hours suggest that it can continue to pump, right? So you have to see that. And what's going to do is it's making a rising wedge. And it's either going to go parabolic out of it or break down, right? And so this is what most people, this is really the next trade, the next possible trade. It would be the enter. That's an aggressive entry right here. The cool thing is you only risk 10%, right? So, like if someone put 100 grand in here, they'd risk 10 grand and make 30,000, right? That's kind of the case. This likely could break out. 12 hour looks interesting. 8 hours a bit rolling over. 6 hours a bit rolling over. The 4 hours still rolling over. Again, it's like this level that everyone watched before, the retest. So it brings us right to this area. And see how you can zoom out, zoom in, and then really start to see things the way you want to see them. Or not the way you want to see them, but like the charts start to give you more information. I don't mean like we force it to see what we want to see, but the chart starts to give us more details that fill in the blank and make more sense, all right? When they waited for the whole Fed meeting and then just dumped the price. I'm telling you right now, a short is in order, likely to make money to the downside. But do whatever makes you happy. So Casper, so I'm like staring at my trade. I'm like, what am I getting in the zone? Resistance, resistance, resistance. Big support there. Let's take a look at our 15-minute. Can it respond? The smaller time frames are going to tell us whether we lose or hold these areas. All right. right now, possible scalp out of this falling wedge, the upside for Caspa. These are the strongest coins with the most volume and the most attention right now, and it's close to, price discovery. So it's going to be the one that, if Bitcoin takes a huge move, regardless, but it's going to be the one that will get its move, most likely get its move, right? So this is what we're looking for there. Possible 13% move out of Casper, or even just to the top of this channel. You want to see that it can hold this level. If it doesn't hold this level, right, you're bearishly retesting this to the downside. If it holds this level, we could get an explosive parabolic move. This is a key area for Casper. We got to really focus on it. And, and at one point you have to decide, a person or a trader has to decide whether they want to pull the trigger or not, right? Completely up to them. So it's always dumb when no one thinks it's a dump, right? Is Bitcoin attempting some hidden bullish on the 15-minute? Slightly, right? Let's see. I mean, this says it's got a bullish div now, which is really weird to me. It's like, this says it's going to reverse. I don't know what kind of bullish div that is, though. Like, it's weird. I see more downside because descending triangles love to dump, and I trust them like the most. They make the most money the fastest. So I would watch for a descending triangle to dump to the downside. All right. Sam, are you a low-key time traveler? That's how he hit the gains all the time. Hey, man, you never know. You never know. Show us the trick. It's actually not that hard to go back in time. All right, let me teach you guys. All right. Don't tell. I'm going to reveal how to travel back in time. Most people won't believe me, and that's fine. So it's great. You know what I mean? But look, we live in a toroid, all right? Google this. But we live in a toroid. All right? Everyone thinks we live in the globe, in a circle, Earth flat, all this stuff, right? And you hear all this stuff. But you have to understand, here's the globe, right? Inside of the globe is an energy force. There's a circle here. There's a circle here. Okay, this moves out. This moves out like an hourglass. Sorry, let me draw this right. All right. These are the circles, okay? Energy flows inside and comes out, right? Flows inside and comes out. This is the toroid, right? A toroid is basically a circle here, but a bigger circle around it. And then there's a circle here. And the energy's flowing out and inside, all right? So if you write, let's see if we can get like a picture of a toroid in space and time, A toroid. Why is it not showing me the toroid? Does it need another R maybe? They don't even want you to know this stuff, so you can't even. There it is. See that? It's a toroid. See the toroid? This is what I want you to understand, okay? Now, this is how you time travel, all right? By moving from one area in the toroid to the other, okay? And it's very similar to, right? And did anyone ever show you the experiment? Let me see here. You'll have a piece of paper, okay? You're in two dimensions, and you could have a two-dimensional ant right here that needs to travel, all right? Okay? Now, a two-dimensional ant needs to go from here to here, okay? That's going to take it, that's a lot of space for a two-dimensional ant. But if I can take this and I can turn it into 3 dimensions, which is a circle now, the ant can time travel from one area to the next. And he's a one-dimensional ant, but he's moved because he's now in the third dimension. He's in the third dimension. Okay? Everyone understand this? So we just need to access the 4th dimension in order to time travel. Makes perfect sense to me. I don't know if it makes sense to you. Anyway, we can get there at another time. This is this is for another YouTube channel. Bro, that actually makes sense. Not try a Mobius strip, yo. No, it seriously does, man. It's crazy. Anyway, yeah. They're going to playing games with the charts today. That's what they're going to do. Let's see if this divergence picks out. But, I mean, you have really high RSI stochastic. And, Now you have a resistance for Bitcoin at 26,950, right? You have to get back above this level to remain bullish. Funny, this indicator says we're going to spike right back up to the 200 SMA. You know my old trick? I mean, there's the yoke. There's the divergence. You should get the bounce back up right now and squeeze all the late shorts, right? Could definitely happen. For me, I'm all about this resistance. It's kind of an M. If we come here and flip, fine, then I'll long. Or one of these, or flip the 50. But I remain short right now based on what I'm looking at. And this has a nice leg to the downside. When it does short, if this does fall, it'll fall pretty fast. And you'll make the money within seconds. Like shorts, I've been shorting more than ever recently, and it makes more money. It just makes fun. It's fast. Short money is fast money, right? So my peoples have traded the 15-minute on the long because I just, the 1 hour is more powerful. The 15-minute just crossed the dotted line usually means it's getting for more downside. This 1 hour is about to take you down, in my humble opinion. Very likely, but again, who knows? I'm not the end-all. You lost this POC. That means you're coming down to this line here at 24,494. So very likely you're dropping down to this 200 SMA and then further into this liquidity zone. The 1 hour is going to take you there. I don't know. I could be wrong, but the probability is that we're going to drop somewhere to 26,000. You can see the liquidity waiting for us. At that point, we may reverse back up and gobble up 28K. But it just looks like we're going to sweep the lows first, all right, before anything else. And I could be wrong. Again, I am not a financial advisor. Nothing I say and do should be taken as financial advice. Everybody, thank you so much for a wonderful second live stream. I can't believe how many people stuck with me. 550 people here, 344 likes, $4.50 in chat revenue. Well, may God bless you all. Thank you so much for each and every one of you coming on in, and we'll see you on the next live stream. Watch this 1 minute bear flag, really, if you want a short. This is really the key here to the short. This starts to drop, we're going to get paid pretty nicely. Stokes tell us that we can. Let's see what happens. It's just probability. That's all. That's all. Everyone, thank you so much. Have a wonderful day, wonderful afternoon, morning, night, wherever you are in the world. And spread positivity and love no matter where you go. You can't go wrong. Live in gratitude. Be thankful for everything you have. And I'm telling you right now, God will bring you more. God will bring you more. Everyone, thank you so much. Have a wonderful night, day, afternoon, as I said before. And I appreciate you all. Thank you. I'm just going to let this run for about a half an hour.